market has opened quite strong actually, almost a 500-point up move on the Sensex. But as we've seen in the past, it's moved from extreme fear to extreme euphoria in less than a day. So let's see how long all of this lasts. For now, Tushar Pradhan, the CIO India of HSBC Global AMC, is with us. Tushar, hi, good morning. What's your own sense? Do you think the worst of the fall is behind us, or should we brace ourselves for more volatility in the Indian market?
Well, the Indian markets are always going to give us something to think about. So I think it's very difficult to make a call whether the worst is over or not. But I think you have to focus on two things. One is the factual data, and the other is the sentiment, which is both local as well as external. I think for now we have probably seen a perfect storm of bad news coming from external, from local macro, and all of these issues put together. But I think if you look at the silver lining, earnings continue to remain pretty optimistic going into this quarter. While there has been some reason to worry about certain sectors in the economy, I think it is very clear that bottom up, if you look at the ground level situation, I think that's probably turning out as positive as possible. The reduction in valuation is of course giving comfort to longer term averages in terms of what valuation multiples trade at. And I think over time it is very easy to kind of now look back to say, look, this could have been a better time to invest. So I think I'm going to kind of hedge that question to say, well, I don't know whether the worst is over, but I think clearly a lot of the bad stuff is over.
But Tushar, what about the NBFC sector? They are dithering for reasons, other than just global. The amount of money we saw pulled out of liquid mutual funds, 2.1 lakh crore last month, hardly any of that has come back. There is a liquidity crunch, not in the money market, but for the NBFCs. Can that impact consumption? So how is that chain looking to you?
Yeah, so I think if you look at the NBFCs, and again I emphasize the fact always that the NBFCs, each of them have a different focus, and each of their markets are very different, and their ability to raise capital to service that market also is different. So it's not a generic answer. So I think for companies which can show robust growth, and which is what they've been showing in the last few quarters, and which is kind of ring-fenced from all of these very large macro moves, say for example companies which finance consumer discretionary items, I think it's a matter of changing the capital structure, right? So for now, if the banks were not the preferred route for raising capital for them to disburse, it was the mutual funds, the CPs and stuff like that. Now, when there is, and again I must say this is, again as you mentioned yourself, it's not a liquidity thing, it is really a confidence thing. So if one lender has gone away, not because of their own volition, but the fact that they don't have the support of their investors, there's not money. There's not much money to actually invest in the CPs. So they just move to another lender, and I think the right kind of noises is something that we are hearing from the banking sector, where they're saying we are going to come and support the NBFCs as much as we can. And I think on a rising interest rate, given the fact that deposit rates don't go up, I think the difference between what the liabilities are costing them and the kind of asset yields that they're looking at, I think any bank would love to take this net interest margin going into March. So I think it may not be really such a very large problem, and if I take the NBFCs together as an average, it may not really be a big problem. But clearly there are NBFCs who may face a significant challenge in terms of their basic market and the ability to raise finance to ensure that they continue operations. Okay. So I think not a very generic answer to this question. Sure. I think then one has to be specific.
Okay. 428 points higher on the bank Nifty. It's a trending move. NBFCs really, Shriram Transport and Cholamandalam Finance, they are the ones which are now surging. In fact, Shriram Transport is now up about 8%. And you have very quick move now happening in Cholamandalam Finance as well. Edelweiss, of course, today is a macro move on NBFCs, and a lot of these banks, PSU banks also now joining in the party. So a lot of these stocks are surging. So Tushar, good morning first of all. The last 6 months has been all about moving to IT and pharma and taking money off financials. Is that large trade done, you reckon, or is of course right now screen looks good and financials look good, but do you think that is still the big trade in this global risk-off environment?
So again, I would like to emphasize that there is the fundamental case to invest and there is the valuation case to invest. So I think in the past, most of the investment decisions were taken on growth, and generally the money followed growth, so that gave a lot higher multiples, and people were willing to give multiples to companies which are showing growth. Now after this correction, I think the investment universe is looking a lot more attractive from a valuation perspective. So it is not necessary to say that that may be the trend of going away from IT and pharma. I think IT and pharma were becoming attractive from a currency perspective, from the inherent growth that we were seeing in IT especially. Suddenly the momentum of earnings was shifting into these sectors, and I think that was a combination of all of these factors. Will they go back? I think definitely there is a lot of value which has emerged, especially in the financials, as well as some of the larger, more diversified set of companies within India. So I think it may not be a generic move, I mean as so specific as you mentioned, but clearly I think there are interesting valuations which are giving rise to tremendous opportunities. So for the reasons why we went into IT and pharma as a market, I think may not be the reason to go into somewhere else. Clear the valuations are the one which is driving investment opportunities right now.
No, but will you buy more IT names? I mean, you do have names like Infosys in your funds. We got some really good commentary from the management of TCS. They expect double-digit growth through the course of this fiscal. Will you put more money to work in the IT space now?
I think the IT space is looking pretty attractive for 2-3 reasons. One is the fact that the GDP growth rate, as we know, in the US continues to remain very strong. Discretionary spend on IT, especially companies which are very cash rich in the US, are looking at a tremendous opportunity to deploy the money that they've made, the profits that has been generated, into investing for IT infrastructure. I think all of that is giving us a lot of confidence that this kind of momentum is likely to continue. What is of course giving a lot of tailwind to current earnings in the IT companies is of course a weaker rupee, and I think most of the analysts may have taken a very different exchange rate to kind of estimate earnings. So I think going forward there is a lot more to come in terms of earnings upgrades as we get to see the story a lot better, and I think once that gets articulated and we settle down to a much more, let's say, recognizable exchange rate, I think that's something where the opportunity still exists. But I will again emphasize that IT is a place where the interest is coming from general growth as well, so just not the currency move.
Tushar, the events of the last 12 hours are giving a sense of calm. Crude is at 80 and US yields are at 3.15 and the dollar is at 95. But genuinely the financing conditions in India have gotten tighter. Yesterday we had the Blue Star and Vijay Sales guys, and it was very clear that they are expecting AC sales. If they were expecting it at 10%, now they are scaling it down for the entire sector to 5%. There's costlier money to boot. I mean, therefore, are you bringing down the earnings expectations on consumer durables or even automobiles for that matter? Are they your pick at all?
See, again, I'll emphasize, Lata, the difference between the fundamental nature of a company and the valuations that they trade at. So in the past, what was happening is that the growth in the underlying business was leading to an expectation that growth is probably likely to continue at these rates. And then the multiple that you give for such growth rates is a lot higher than average. Now, when the growth starts to taper off, and we are not talking about the fact that it's actually come down or something, but maybe if you adjust it a little downward, then the attractiveness of the company and the valuations that the market is likely to give starts to come down. And I think that move is something which someone can take a tactical call on. But it is fundamentally really not that much of an issue. So I think if you look at the term for which you're investing, so suppose you're saying, look, I want to build a portfolio which lasts over the next 2, 3, 5 years, then I think there is no difference in terms of how you would look at consumer durables. The consumption story in India remains strong. But if you're looking at a tactical move, I think clearly overvaluation in these leading into this quarter is clearly going to take some valuation sheen off, and then you look at something else, to kind of buttress that investment, opportunity. So that's how we look at it. I think some money taken off somewhere from somewhere because of the very, very large overvaluation in some parts of the sector is something which could happen.
Okay, just one final question from my end then. You have Yes Bank in one of your portfolios as well, in one of your funds, that is. The stock is up almost 40% from its lows. Do you think that the worst of the management uncertainty is now behind us, and is this still an opportunity for long-term investors?
Let me again tell you that we won't be able to speak specifically about any one company. What we do like, however, of course, about the entire private bank space is the fact that they clearly, definitely have a much better quality of asset book. The asset liability mismatches are somewhat much more better managed. And I think overall, the management quality in terms of how these companies have grown so far and how they've managed their growth is something that leads us to make a lot of confidence in terms of holding them for the long term. So I think that's really the reason. There are certain stock-specific issues which cause volatility in stock prices, leading from stories, from events and stuff like that. But I think as a long-term stock picker, I think one should clearly understand that the story is never going to be a smooth sailing incremental per day. There are going to be events, and I think as long as you understand the upside potential over the long term, I think we can remain invested no matter what happens in the short term.